Hi, in this video, I'll walk you through an example of computing income tax using the marginal tax rate table. All right, so this is an example of a marginal tax rate table. The word marginal in economics means it applies to the next one item. So for example, marginal cost. Okay, so let me put it on the margin here. Haha, margin. And when I'm done, I'll erase it. For example, marginal cost. Let's say that you're a consultant and you do training for a company. In order to set up the training, you have to do research and preparation and a lot of work that costs you, let's say, $5,000, including of your time and creating the handouts and everything. You charge them enough money to pay for all your costs, and let's say you expect 10 people to show up at the training. And then they decided that they really need to hire you to train 11 people instead of 10. Then that extra one person really only costs you one extra copy of the handout. That extra person doesn't require you to go back and do extra research or extra preparation. Just the cost of handout and maybe some extra time for answering questions from one more person. So the marginal cost is that extra cost, the cost of that extra person, which is basically one extra handout, compared to the total cost, which includes paying for your time to prepare and research and hiring a graphic designer, etc., etc. All of that is not part of the marginal cost. So back here for marginal tax rate, then that means we're looking at the tax for that extra $1 that you're making. So marginal tax rate is the tax rate for the next dollar you earn. This bracket, for example, this applies to taxable income, not your gross income. So from your gross income, you get to adjusted gross income, and then you get to taxable income. For every dollar you make up to $9,700, you pay 10% tax. But for the dollars after that, you pay 12%, up to $39,475. And then after $39,475, you have to pay 22%, etc. So graphically, it goes like this. If this horizontal axis is your taxable income, from 0 to 9,700, you pay 10% tax. So it goes up by 10% slope like that. From 9,700 to 39,475, every dollar you make after that is taxed at 12%, so it's a slightly higher percent. But it only applies to these dollars, the dollars that are after the 9,700. Again, because it's marginal, so it applies to the next dollar. It doesn't go back and retroactively charge the old dollars 12%. And once you get here, for the next dollar after 39,475, you're paying 22% in taxes. So it's even a higher percent, all the way up to 84,000. And then from that, it's 24%, then 32, etc. Overall, the curve is not straight, but it bends upward like this. When you have a taxation that bends upward like that, then it's called progressive. The more money you make, the higher percent you pay for the next dollar. All right, now let's do an example. Let's illustrate with this situation of a single person with taxable income of 61,000. Using the table above, then the first bracket goes up to 9,700. So that means for this single person with taxable income of 61,000, the first $9,700 of taxable income will be taxed at 10%. And then up to 39,475 will be taxed at 12%. And then up to 84,200 will be taxed at 22%. And if they had any more money, they would be taxed at 24%, but no, this person makes 61,000, so it's within this amount. How much of this is actually applied to this person? Well, this person definitely has the 9,700. Well, for the next bracket up to 39,475, how much money is that? They already paid 10% on the 9,700, so they're not going to pay anymore. So we're actually looking at 39,475 minus 9,700. So that's equal to 29,775. That's up to 39,475, and then from 39,475 to 61,000. So that's the difference of 21,525. They're subject to the 22%. So yeah, they didn't go all the way up to 84,000. They're sort of like stopped here at 61,000. So here's the idea. The 9,700 is subject to the 10%. The 29,775 is subject to the 12%. And the 21,525 is subject to the 22%. If you add these three pieces together, you get 61,000. So basically, you take the taxable income of 61,000, you break them into pieces, one piece in the lowest bracket, and then whatever is left, whatever fits in the next bracket goes in there. And then if there's some extra, whatever fits in the next bracket, and then you compute. So 9,700 times 10% for the lowest bracket, 29,775 times 12% for the next bracket, and then 21,525 times 22% for a third bracket, and then you have the total tax. That's the visual approach. Now let me walk you through the steps. How do we do this step by step? When I illustrated, I went from the first dollar to the last dollar. So the first 9,700, and then the next 29,775, and then the next 21,525. When you do this for real, it's actually simpler if you go backward. If you do the top bracket first. Step one, you determine the taxable income. In this problem, we really don't have to do any calculation because we're given that the taxable income is 61,000. So we don't have to compute it, it's given. Step two, find the highest bracket this is in. This is the highest bracket, okay, because it's higher than the 39,000, but it's still up to 84,000 only. Step three, starting there and going down. Determine how much of taxable income is in each bracket. So the highest one is 22%, so I go 22% of, and each of these is a subtraction, 61,000 minus the limit below it. I look at the limit below it. The next one lower is 12% of, and then I look at the limit below it. So 39,475 minus 9,700. And 10% of 9,700. And in theory is 9,700 minus 0. So these are your taxes. So let's calculate. 22% of 61,000 minus 39,475 is 21,525. 12% of 39,475 minus 9,700 is 29,775. And 10% of 9,700. So it's 0.22 times 21,525, 0.12 times 29,775. Each of these is a 7. and 0.10 times 9,700. I get 4735.50. The next one, 0.12 times 29775, I get 3573. And the third one, 0.10 times 9700, I got 970. I add these together. 9278.50. All right, hope that helps. Thanks for watching. Bye.